Let's get a quick check on the market. Somewhat of a mixed picture. The Nasdaq hitting a fresh record high, getting a little bit of a boost from some of those headlines out of Washington. As we were reporting earlier today, the Justice Department dropping its criminal investigation into Fed Chair Jerome Powell, presumably paving the way for confirmation of Kevin Warsh. And I'm curious what you all think this means for stocks. Obviously, he's someone who has advocated for lower rates. How much of that you think is priced into the market at this point in time, Jim?
Yeah, first off, I think it's exceedingly positive, and it comes under the heading of we've got work to do, Leslie. I mean, as an economy and as a country, we've got work to do, and to waste time on a nonsense investigation that is purely political is a waste of time. We don't have that time to waste. Okay, so we're done with it. Great, let's move on. Kevin Warsh will be confirmed. Now it's going to get interesting, though, because he has some work to do. He wants to lower interest rates, and this could be a case where the Federal Reserve, the committee itself, goes against what the chairman wants. I think he's got a pretty tall bar to clear in terms of convincing everybody on the committee that that's the right move. Now, we also know that he wants to shrink the balance sheet, which in essence would offset partially those rate cuts. And there's a conceptual, intellectual basis for that. I get that. And I like it, by the way. I think, however, that move of shrinking the balance sheet is going to take a lot more time compared to the speed with which he wants to cut interest rates. Now, let me get to the good news. Okay, there's going to be a fractious debate on the committee. The market, the economy, doesn't need rate cuts right now.
Right.
It just doesn't. We can see it in profit growth. We can see it in economic growth, in the labor market. So I think we're okay, however that turns out.
That's the other side of the coin. And to your point, consensus is increasingly important there. Let's get to Steve Liesman with more on this story. Hi, Steve.
Hey, Leslie. Yeah, the U.S. Attorney for the District of Columbia announcing she has dropped her probe into Fed Chair Jay Powell criminal probe and cost overruns at the surrounding a Federal Reserve building renovation, apparently clearing the way for Kevin Warsh to be voted on by the Senate in a nomination. Pirro saying in a tweet, quote, "I have directed my office to close our investigation as the IG undertakes this inquiry. Note well, however, that I will not hesitate to restart a criminal investigation should the facts warrant doing so." It's worth noting, however, that Fed Chair Powell asked the IG to do this back in July 2025, and the IG confirming in a statement, of course, that the investigation is ongoing. Warsh's nomination vote has been held up, of course, by Senator Tillis. Senator Tom Tillis said he would not vote to confirm Warsh until Pirro dropped the investigation. We have yet to hear from Tillis on this issue, but a White House spokesperson saying in a statement, the White House remains as confident as before that the Senate will swiftly confirm Kevin Warsh as the next Fed chair. Now, take a look at the two-year yield. It dropped a few basis points on the news, apparently on the belief that Warsh will be a little bit more, what would you say, dovish than Fed Chair Powell, but it hasn't retreated back. You can see there to the before the Iran conflict, before the U.S. attacked Iran. So it still has some ways to go to really confirm this idea. And when I look, guys, Leslie, at the Fed funds probabilities, it continues to show less than a 50% probability of a rate cut between now and July 2027. So right now, the market thinking maybe along the lines of Jim Leventhal that a rate cut is not needed, or that because of the lingering inflation from this event, that a rate cut, the Fed cannot cut rates.
Right. Yeah, I was just going to say, we were just talking about that. Go ahead, Jim.
Hey, Steve, I didn't know you were going to be on, but since you are, and we can get a little wonky, R-Star. You know, there's two schools of thoughts here. Kevin Warsh is of the idea that AI-led productivity will lower R-Star. Ed Yardeni is an example of the other school of thought that the economy is going to run hot because of AI and that R-Star is going up. Do you have an opinion on it?
You know, I'm going to answer you, Jim, in a not wonky way, which is I'm going to tell people to look at the Wall Street Journal, which talks about the tremendous needs for funding for AI, Jim. I'm talking to people that are talking like billions a week are needed to invest in AI. And now use your Econ 101 hat, which again is not wonky or nerdy, and say, what happens when the demand for something, in this case capital, goes up? In that case, at least on the front end of this huge AI investment boom, it puts upward pressure on interest rates. Now, maybe somewhere down the road, Jim, you and I are facsimiles of ourselves and we're AI agents on TV and we don't have to be there and the productivity of our news reporting goes up tremendously and there's downward pressure. That's in years to come, Jim. But on the front end of this, there's a really good argument that it puts upward pressure on capital, upward pressure on interest rates, and the Fed needs to basically do nothing along those lines, or at least not cut rates in the face of it. So I know for sure Warsh is going to get some pushback from other members of the FOMC that are going to adopt that kind of thinking.
All right, Steve Liesman, thank you. Not too wonky at all. I thought that was a good discussion. Appreciate your time this Friday. So, Jenny, we saw a little bit of a reaction on the 2-year yield here. What do you think ultimately happens with regard to getting that consensus to lower interest rates? The market doesn't think it's going to happen until mid next year. Do you think there's a case to be made whereby the economy deteriorates and it becomes necessary and they get that consensus?
Well, I think there's a case to be made that the economy deteriorates and it's for all the wrong reasons. And maybe, Leslie, maybe they even need to hike rates. And I'm surprised that in our 6 minutes so far, we haven't started talking about this yet because the Strait of Hormuz and the reverberations and aftershocks that are coming, that may come to the supply chains from that, have really high potential to be wildly inflationary. And this is like a total unknown, but it's also a reasonably high probability that we need to think about. So the way I see it is, here we sit in mid-April. Ships left just before the war started 2 months ago. They're just reaching their destinations now. There is no real global, yes, we can say there's diesel issues in the Philippines, that's real. There's diesel issues in Egypt, that's real. But collectively, we haven't even begun to see the problem of 1,000 ships still being stuck there. We haven't even begun to see what the problems are from nothing getting out of the Strait of Hormuz for the last 2 months, because again, from a supply chain issue, ships left and they're just arriving at their destinations on time now. And so what's going to happen is a huge if. But what if? What if it doesn't open anytime soon? What if, once it does open, we find that there is enormous infrastructure damage to aluminum smelters and more to fertilizer and helium. What if this all becomes real? What if there is real damage to LNG supply chains? And what if that triggers inflation? And I think at the root of it, I think we need to give Warsh credit for being a proper professional economist. And he's going to deal with this intelligently. So he might have real inflation coming. He might not, right? But he might. And so we're in this funny time where you just don't know. And it could be extreme on either side. And I also think that with respect to AI and efficiency, that's legit and that's real, but that is a longer way off than potential inflation from supply chain reverberations and all that from coming out of the Strait of Hormuz.
What do you think, Kevin? Do you feel like it's as binary as long as the Strait remains impassable, the Fed cannot lower interest rates? That's something that Wells Fargo's CEO Charlie Scharf insinuated earlier this week, that basically as long as this war goes on, there may not be a case to be made to lower those interest rates until you have a little bit more clarity around the future implications on inflation.
Yeah, that may oversimplify it a little bit, but I agree with the thesis. I don't think we're in a position where we can be thinking about rate cuts at this point. I'm happy that Jenny's worst case scenario isn't playing out at the moment. Right. And we were almost there. I mean, if we saw energy prices or oil between 150 and 200, then everything that you just laid out would be happening and it would be a rate hike conversation. Fortunately, that worst case came off the plate collectively. So if we're $70 to $90 a barrel, I think the market is assuming it can absorb that for a while. Now, do we want to have rate cuts? Sure. What stock investor doesn't want that? But I think the reality is that that's probably, to Jimmy's point, not something that we should be considering specifically because we don't need it. Can we down the road? Can housing come in and bring inflation down because of a massive lag effect? Possibly. Can energy come back to where it was before the invasion of Iran? Probably not in the short term. So I would think it's more about just kind of holding the line and making sure that inflation is staying level. And if we can avoid either of the extremes, that's probably a best case scenario.